All right, let's just jump right into this explainer. Today, we're unpacking the Q1 2026 financial health and valuation of Ferguson Enterprises. Look, if you follow industrial distribution at all, you already know Ferguson is an absolute heavyweight. But today, we are skipping the dense SEC jargon. We're going to look at what the raw data actually tells us about their earnings, their margins, and ultimately, whether the market is pricing them right.
$4.7 billion. That's the exact amount of share repurchases Ferguson managed to complete under their 2021 authorization program by March of 2026. I mean, just think about the sheer scale of that cash flow for a second. That is not a rounding error. It signals a major, aggressive commitment by management to return capital to their shareholders. And honestly, it sets a very specific tone for how they view their own valuation and financial stability.
Now, to understand exactly how they fund that massive capital return, we kind of need to look at what they actually do. Ferguson is a massive distributor of specialized professional water and air solutions operating all across North America. We're talking about the pipes, the valves, HVAC components, waterworks infrastructure, basically the essential stuff that quite literally keeps communities running and new construction moving forward.
So here's our roadmap for today's explainer. Section 1, we'll hit the overview and Q1 highlights. Section 2, financial health and margins. Section 3, valuation and market position. Section 4, dividends and shareholder value. And finally, Section 5, future outlook and risks.
All right, let's kick things off with Section 1, overview and Q1 highlights. So the crucial takeaway right off the bat here is this remarkably solid top-line growth. Net sales bumped up 3.6% from $7.21 billion to $7.47 billion. Now, if you dig into the filings, this was primarily driven by mid-single-digit price inflation, along with some strategic acquisitions, which honestly more than offset some slightly lower volume they had. But take a look at the bottom line. That modest sales growth translated into a really healthy 20% jump in net income to $414 million. And that pushed diluted EPS up over 23% to $2.13. I mean, that is some serious operational leverage at work right there.
But you know, under the hood, it's really a tale of two markets. The U.S. segment, which obviously makes up the vast majority of their revenue, really drove growth through robust non-residential projects. Things like commercial, mechanical, and waterworks were up about 8%. Meanwhile, the Canadian segment saw a modest 5.5% rise in sales to $326 million, mostly helped by acquisitions and foreign exchange. But they actually faced some distinct margin pressures that hindered profitability in that specific region.
Moving right along to Section 2, financial health and margins. Okay, so despite all the macroeconomic uncertainty and inflation we've seen sweeping through the industrial sector lately, Ferguson actually managed a 30 basis point expansion in gross margin, moving from 30.7% to a clean 31%. Now, I know 30 basis points might sound small in isolation, but remember, on $7.5 billion of quarterly sales, that is a massive chunk of change. Management attributes this win to solid execution, strong pricing power, and highly disciplined cost management across their entire vast distribution network.
Translating this balance sheet data for you, well, first off, they're sitting on a very comfortable $820 million in cash. But the 1.0x net debt to adjusted EBITDA ratio, that's the absolute hero metric here. The company's stated financial goal is to maintain a conservative leverage target of 1 to 2 times. So sitting right at the bottom edge at 1.0x shows that management is keeping liquidity extremely safe. It gives them maximum optionality for future M&A or, navigating any unexpected economic downturns. Plus, a current ratio of 1.78 proves they have absolutely zero issues covering their short-term obligations.
All right, let's pivot to Section 3, valuation and market position. So take a look at this number. This is Ferguson's trailing P/E ratio, sitting at 22.79. Now, when we look forward, that forward P/E drops just a bit to 19.74. What you should really take away from this is that investors are definitely willing to pay a premium for Ferguson. Make no mistake, you aren't buying a deep value stock here. You're paying up for steady, predictable earnings growth, high margins, and a dominant market position that competitors really struggle to replicate.
And here we have their EV to EBITDA ratio at 15.18. This metric really matters because it factors in their $4.1 billion total debt load along with their cash, which provides a much clearer picture of total enterprise value relative to their core cash profitability. A mid-teens EV to EBITDA multiple again completely reflects a premium industrial distributor. It's obvious the market clearly respects their cash generation capabilities.
Which brings us to Section 4, dividends and shareholder value.
As I kind of hinted at earlier, this company aggressively returns capital. I mean, in just 3 months, they deployed $236 million into stock buybacks, reducing the share count and boosting that EPS we talked about earlier. And on top of that, they paid $174 million directly into shareholder pockets via dividends. You do the math, that is over $400 million of value returned in a single quarter.
Breaking down the dividend profile specifically, FERG yields roughly 1.56% annually. Now sure, that might not turn the head of a high-yield chaser, but the safety here, it's practically bulletproof. With a 34.88% payout ratio, they are retaining over 65% of their cash to fund operations, reinvest in distribution centers, and execute acquisitions, all while maintaining that super reliable $3.56 annual payout. And building on our initial hook from the start of this explainer, because they completely exhausted that previous $4.7 billion program. The board of directors just authorized a brand new $2 billion share repurchase program in April 2026. This totally replaces the old one and basically ensures that this massive engine of share count reduction is going to keep running at full steam.
Finally, let's wrap things up with Section 5, Future Outlook and Risks.
This quote from the Q1 earnings release is actually quite revealing. Management is explicitly acknowledging the uncertain economic environment. They definitely aren't wearing rose-colored glasses here. But they are banking heavily on long-term secular drivers, the desperate need for water infrastructure upgrades, the rise in large capital projects, and an aging, frankly, underbuilt housing market. These are the structural tailwinds they believe will maintain their competitive moat for the long haul.
Backing up that sentiment, their official calendar 2026 guidance remains completely unchanged. They're projecting a conservative low to mid-single-digit sales growth. But crucially, they expect to hold the line on profitability, forecasting adjusted operating margins between 9.4% and 9.8%. Plus, they're deploying $350 to $400 million in CapEx, which proves they are still actively investing in growth and technology, despite any broader macro fears.
So, balancing their exceptional cash generation, expanding margins, and that aggressive $2 billion buyback program against the clear macroeconomic risks and those pressured Canadian markets we saw, we leave you to analyze and decide, does the raw data and their fortress of a balance sheet truly justify the current market premium? It's a genuinely fascinating setup for an industrial heavyweight. Thanks so much for joining me for this explainer today. I really hope this gave you the clear, structured insight you need to fully understand Ferguson's true market position. Catch you next time.